The day the system broke, October 29, 1929. Black Tuesday. The day the stock market didn't just fall, it collapsed. Fortunes evaporated in hours. Millionaires became destitute. The financial system that everyone trusted revealed itself as fragile, and most investors were completely unprepared. But here's what most people don't know. While the majority lost everything, a small group of wealthy investors didn't just survive. They got richer. They bought assets at 10 cents on the dollar while everyone else was selling in a panic. The difference wasn't luck. It was preparation. They followed 3 core principles that most investors ignored. These same principles apply today. If you understand them, you can position yourself to weather any market collapse and come out stronger on the other side. Let's break down exactly what the strategic investors did differently. The cash fortress, liquidity is king. The crash exposed one brutal truth. Most investors were over-leveraged. They bought stocks on margin, borrowing heavily to amplify their gains. When the market turned, they were forced to sell at the worst possible time to cover their debts. They had no choice. No liquidity means no options. The wealthy investors who survived did something that seemed boring at the time. They held significant cash reserves. 20 to 40% of their portfolios sat in cash, short-term government bonds, and gold. Not because they were pessimistic, because they understood that liquidity creates optionality. When assets crash, cash becomes the most valuable tool you can hold. While over-leveraged investors were forced sellers, the cash-rich investors became strategic buyers. They had the capital to acquire quality assets at fire sale prices. Liquidity gave them power when everyone else was powerless. Think about this principle in practical terms. Liquidity eliminates panic. When you know you can cover your obligations without selling investments at a loss, you make rational decisions instead of emotional ones. You're not reacting to the market. You're responding strategically. The psychological benefit is just as important as the financial one. Investors with liquidity sleep better during volatility. They don't check their portfolios obsessively. They don't sell at the bottom out of fear. They wait for opportunity. Now, how do you build your own cash fortress today? You need 2 types of liquidity. First, an emergency fund. This covers 3 to 6 months of living expenses and protects you from forced liquidation during a personal or market crisis. Second, an opportunity fund. This is capital you keep liquid specifically to deploy when assets become undervalued. The common mistake is confusing being fully invested with being strategic. Many investors think holding cash is wasteful because it's not earning returns. But cash isn't dead weight. It's dry powder. It's the resource that lets you act when others can't. Consider the alternative. If you're fully invested and the market drops 30%, you have 2 options. Sell at a loss to raise cash or sit on the sidelines while assets are cheap. Neither is ideal. But if you held liquidity going into the downturn, you can buy quality investments at a discount while others are scrambling. The wealthy survivors of 1929 understood this. They weren't trying to maximize every dollar of return in the short term. They were positioning themselves to capitalize on inevitable market dislocations. Liquidity kept them alive during the crash. But more importantly, it kept them wealthy by giving them the power to buy when fear dominated the market. Cash isn't just a defensive position. It's an offensive weapon when deployed strategically. True diversification. Asset class depth. Most investors think they're diversified because they own 10 different stocks. They're not. They own 10 different pieces of the same asset class. When the stock market collapses, all 10 positions fall together. That's not diversification. That's concentration with extra steps. The wealthy investors who survived 1929 understood true diversification. They didn't just own stocks. They owned income-producing real estate. They owned private businesses. They held commodities. They had international exposure. They structured their wealth across fundamentally different asset classes that responded differently to the same crisis. Here's the key insight. Different asset classes react differently to the same economic event. The stock market crashed in 1929, but farmland still produced crops. Rental properties still collected rent. Private businesses with strong cash flow still generated income. Bonds still paid interest. The wealthy didn't lose everything because everything they owned wasn't tied to the stock market. This is the protection mechanism that most investors miss. When one asset class collapses, others stabilize or even appreciate. Real assets, land, property, commodities, often hold value or increase during financial panics because they have intrinsic utility. You can't live in a stock certificate, but you can live in real estate. You can't eat a bond, but you can eat the food produced on farmland. The modern misconception is that portfolio diversification means owning a mix of large-cap stocks, small-cap stocks, and international stocks. That's better than owning one stock, but it's still not true diversification. You're still entirely exposed to equity market risk. If the stock market falls 30%, your entire portfolio falls with it. True diversification today means thinking across asset classes. Stocks, yes, but also bonds for stability and income. Real assets like real estate or commodities for inflation protection and tangible value. Alternative income streams like royalties, private equity, or business ownership. International assets to reduce geographic concentration risk. The goal is to structure your wealth so that no single economic event can wipe you out. If inflation surges, your real assets protect you. If deflation hits, your bonds and cash hold value. If the stock market crashes, your diversified income streams continue generating cash flow. You're not trying to predict which scenario will happen. You're positioning yourself to survive all of them. This requires a shift in thinking. You need to stop asking, what will give me the highest return? And start asking, what combination of assets will protect my wealth through any market condition? The wealthy survivors of 1929 weren't chasing maximum returns. They were engineering resilience. The long-game mindset, time arbitrage, liquidity, and diversification protected wealth during the crash. But the third principle is what multiplied it. The strategic investors who thrived after 1929 had something most people lack: psychological discipline. They saw opportunity in chaos. Crashes don't destroy wealth. They redistribute it. Assets don't vanish. They change hands. The investors who panic and sell transfer their wealth to the investors who stay calm and buy. The 1929 crash was the greatest wealth transfer in modern history. The question is, which side of that transfer were you on? The wealthy investors bought quality assets at 10 to 20 cents on the dollar. Businesses that were fundamentally sound but temporarily distressed. Real estate that would recover in value over time. They had the mental framework to act when everyone else was frozen by fear. This is time arbitrage. You're using a longer time horizon than the desperate seller. They need liquidity now. You don't. They're thinking in weeks. You're thinking in decades. That difference in time perspective creates the opportunity for wealth transfer. Why do most investors fail this test? Emotional decision-making. When the market crashes, fear dominates. The instinct is to sell, to stop the pain, to preserve what's left. But that instinct locks in losses and eliminates the possibility of recovery. The investors who survive market crashes are the ones who can override that emotional response. The compounding effect of buying at depression prices is staggering. Assets purchased during the 1929 crash recovered over the following decades and multiplied in value. The investors who bought when others panicked didn't just recover their wealth. They built generational fortunes. This requires preparation before the crisis hits. You can't develop psychological discipline in the middle of a panic. You build it now by understanding that volatility is inevitable, that crashes are opportunities, and that long-term wealth is built by acting when others can't. Conclusion: your strategic framework. The wealthy didn't survive the 1929 crash by luck. They engineered their survival through preparation. They held liquidity to maintain optionality. They diversified across true asset classes to reduce systemic risk. They developed the psychological discipline to buy when others sold. These principles are not relics of history. They are the foundation of strategic wealth building today. Build your cash fortress. Diversify beyond the stock market. Develop the long-term mindset that lets you act during volatility. What strategies are you using to prepare for the next downturn? Let me know in the comments below. If you want more strategic wealth principles, subscribe now.